In today's video, I'm going to take a look at the stock market. I'm not actually going to try and call a top. Tops are just very hard to call. I've never been able to develop any consistent strategies for calling tops, and in my 20 plus years of investing, I've never seen anybody else have any consistent ability to call a top. I've seen people from time to time call tops, but they never do it consistently. So this is by no means a top call. But I will say this, we are getting pretty late in this daily cycle. Here's the daily cycle low. We're 28 days into this daily cycle, and this topped on day 17. So this is potentially left translating this daily cycle. We're at day 28. We're running out of time for this cycle to rally up enough to make a higher high and officially translate this cycle. So there is potential, and again, I'm not suggesting anyone's short, or this is not a guarantee that this is going to happen, but I think we're entering another period of really volatile market behavior, similar to what we had here. And the fact that this daily cycle is potentially left translating could mean that we started an intermediate degree decline here. My original expectation was that this intermediate cycle would only have 2 daily cycles embedded within it, because the one previous to that had 5. Usually you get a short cycle that follows a long cycle. So it's not out of the question that this was our A wave down, our B wave bounce, and we're now getting ready to start the C wave decline into an intermediate cycle low. And I've mentioned this before, that left translated cycles will more often than not, again, nothing is 100%, but more often than not, a left translated cycle will move below the cycle low of that same degree. So here was our daily cycle low. This right now, anyway, this is a left translating cycle. So you would assume that 80% of the time you would expect price to move below this daily cycle low. And considering that we're only that we're on day 28, so this cycle is getting pretty mature. They typically only last 35 to 40 days most of the time. So we've got maybe 12 more days for this daily cycle to find its daily cycle low. Let's say between 7 and 12 days to find this daily cycle low. And if we're about to enter another really volatile phase, it's not out of the question that we could get another semi, not as big as this. I think this is a 4-year cycle low. I don't think price is going below that, but we could get another really volatile move, similar to this, that comes down, drops below this cycle low right here in May. And I've been saying that I thought the ICL would probably occur somewhere between 2,500 and 2,700. So a pretty big band, but somewhere in this zone here would be our intermediate cycle low. So there is potential right now that this could turn into that C wave decline that gives us the intermediate cycle low. And now I'm going to move over to the Nasdaq, because we got a real problem developing in the Nasdaq. So here's the problem. With all of the QE the Fed has printed, they have driven this V recovery, and the problem is they've just pushed price way too far above the long-term moving averages. In this case, this is the 200-day moving average, and you can see there's just too much of a gap between price up here and this average. Let me widen the chart a bit. All right, so this is normal. This is what should happen during a healthy bull market move. You can see we got a little too stretched right here, and it triggered a crash. Again, kind of too stretched here, and then we get the crash back in the end of 2018, and then we really start to have problems when the repo market starts to lock up and the Fed just starts dumping money into the markets. It produces this huge trending move. Price gets stretched way too far above the 200-day moving average, and then the rubber band effect, regression to the mean, comes into play, and you get this violent sell-off back down uh, to the 200-day moving average. In this case, there was such a stretch here that not only did we come back down to the average, but we went considerably below it. So the rubber band had just gotten stretched way too far above the moving average, and you can see what's happened. So we had a normal violent rebound from this push way below the average, and then the Fed has been pumping a lot of money, and so they pumped it again up way too far above the average. So we're getting these really volatile moves back and forth, and it's due simply to the fact that the Fed isn't allowing markets to progress naturally. They're forcing too much money in the market. It's stretching price way too far above these averages, and then they tend to crash. The Fed panics again, prints more money, and you get more volatile moves. So I'm by no means trying to call a crash like I was here. This one was inevitable. I don't know that this one is inevitable, but I do know that this is stretched too far above the moving average, and we're 28 days into a daily cycle. So I don't know for sure that we're going to come all the way back down and test this 200-day moving average again, but I do know that at this point, you're playing musical chairs in the market, and at some point, somebody's going to pull out that last chair, and you're not going to have any place to sit, and you're going to get caught in some kind of a violent move down into at least a daily cycle low. And again, the fact that the S&P is um, potentially left translating the cycle in the S&P, then there is potential that this could turn into a crash event that gives us an intermediate cycle low. So I'll finish off and I'll show you the longer term weekly chart. This is the 200-week moving average, and you can see that this stretch is even more egregious if you're looking at a longer term chart. You can see what happened here as we move down into the 4-year cycle low. Again, all the Fed money printing pushed price way too far above the long-term averages. We get this crash event, and they've done it again, and this time it's even worse. So I would be very cautious right now. I would have some very close stops on stock market positions, and for me personally, I don't want to play musical chairs 28 days into a daily cycle with the S&P potentially left translating into what might be a failed daily cycle and perhaps a move down into an intermediate cycle low. So we took some profits back here when the Qs double topped. We'd been long from down here. I don't need to catch every penny of a rally. I know a lot of novice traders panic when if we get out early and the market keeps going up, they want to panic back into the market instead of waiting for the right setup, and then they get caught at the top. It happens almost every time. It happened back here. Traders watch the market go up and up and up, and a professional trader, we get people that have been in the market for a long time, we get more and more nervous as price stretches further and further above a moving average like this. Retail traders get more and more complacent. They think that there is no risk when the market just keeps going up, and I know better. So at this point, like I said, we were happy. We'd made some tremendous gains. We got in way down here at the bottom, and at this point, I really don't care how much further this goes up. I just want to wait for another one of these things and then get in at the bottom, and that way I'm playing musical chairs with a full complement of chairs, and I don't have to worry about having the last chair pulled out on me. At that point, I should have weeks ahead of me to make money instead of not knowing when the top is going to come and possibly getting caught.